Welcome to The Explainer. I'm your host, and I am absolutely thrilled to dive deep into a real-world stock analysis of Lindsay Corporation today using some absolutely legendary valuation frameworks. You know, in a market that's honestly full of overpriced hype, finding true value is basically a superpower. So if you love stripping away the noise to see the true financial picture of a company, well, you are in exactly the right place. Let's get right into it. Okay, so let's dive into this exact question by looking directly at the raw SEC filing data. Lindsay Corporation, which trades under the ticker LNN, has actually seen quite a bit of recent volatility, mainly due to shifting agricultural cycles. So the big question we have to answer is this $124.85 price tag a massive opportunity, or is it a value trap just waiting to catch unsuspecting investors? To answer that, we're going to apply the rigorous frameworks of some of the greatest minds in investing. Here is our agenda for today. We'll start with a snapshot of the company, apply the Buffett and Graham lenses, move on to the Peter Lynch lens, run a DCF and some alternative valuations, and finally synthesize everything into a final verdict. Section 1. A snapshot of Lindsay Corporation. Currently trading at $124.85, this industrial midcap sits at a $1.31 billion market valuation. And at this price, it carries a price-to-earnings ratio of 22.8 times its trailing earnings. So right out of the gate, we know we're looking at a mid-sized industrial player. That means it's definitely not some deep bargain basement multiple, but hey, we aren't exactly paying those nosebleed software premiums either, right? Note, to understand the earnings, we really have to understand the business model. Lindsay operates a dual revenue model. First up, they provide agriculture irrigation solutions. Most notably, their Zematic pivot systems. Second, they have this fascinating road infrastructure segment, famous for the road zipper system. If you haven't seen this, it literally moves heavy concrete barriers on highways while traffic is actively flowing to manage congestion. It's an absolutely incredible piece of engineering. However, they've recently faced some tough cyclical headwinds. Q2 revenue was down 16% to $157.7 million, and earnings per share dropped to $1.15 for the quarter. This was largely driven by constrained farmer sentiment, lower commodity prices, and high interest rates in key markets like Brazil. But a peek under the hood reveals what I like to call a fortress balance sheet. Looking directly at the raw SEC data, you'll see a massive $186.1 million in cash and cash equivalents. Now compare that to their $114.8 million in long-term debt. This means Lindsay effectively has a net cash position. They absolutely have the liquidity to weather the current agricultural downturn without breaking a sweat, which is going to be an absolutely crucial factor for our upcoming valuation models. Section 2. The Buffett and Graham lenses. Okay, looking through the Warren Buffett lens, we're searching for an economic moat, excellent management, and consistent earnings. Lindsay certainly has elements of a moat, for sure. They have a unique, near-monopoly product with the road zipper and a massive $80 million Middle East North Africa, or MENA, irrigation project sitting right there in their backlog. Management is also very shareholder-friendly, actively executing a $150 million share repurchase program, and their return on equity sits at a really healthy 11.5%. To calculate their approximate owner earnings, we take net income, add back depreciation and amortization, and then subtract capital expenditures. Based on the trailing financial data, we can estimate roughly $65 million in owner earnings, reflecting some really strong cash conversion. But, and this is a big but, Buffett demands earnings consistency. Right now, Lindsay's earnings are highly cyclical and directly threatened by soft farm economics. Because of this inconsistency, Buffett would absolutely demand a very wide margin of safety before even thinking about buying. Moving on to his mentor, Benjamin Graham, the father of value investing. Let's actively check off his defensive investor criteria. Adequate size? Yep, it's over $1 billion. Exceptional liquidity? Yes, with a phenomenal 3.0 current ratio. Positive earnings and a stable 37-cent quarterly dividend? Pass and pass. However, Graham strongly prefers a PE ratio under 15. So Lindsay's current PE of 22.8 is, well, borderline at best, and arguably a bit too rich for a strict Graham defensive investor. To find Graham's exact buy price, we turn to his famous intrinsic value formula. It's brilliantly simple. You take the square root of 22.5 multiplied by the earnings per share multiplied by the book value per share. This is specifically designed to protect the defensive investor with a built-in margin of safety, assuming a baseline valuation of 15 times earnings and 1.5 times book value. So, let's use the provided financial data to extract the exact inputs for this formula. Since trailing EPS wasn't explicitly isolated in the summary data, we reverse engineered it using the current price and PE ratio, which gives us an estimated trailing EPS of $5.47. For the book value per share, we just take their total shareholders' equity, roughly $507.7 million, and divide it by their outstanding shares, giving us $48.59 per share. Crunching those exact numbers, the square root of 22.5 times 5.47 times 48.59 gives us a gram intrinsic value of $77.33. So the crucial takeaway here is that at the current price of around $125, the stock severely lacks Benjamin Graham's required margin of safety. He would likely just sit on the sidelines until the price drops significantly. Section 3. The Peter Lynch Lens. Peter Lynch famously categorized companies into different buckets, and he would immediately peg Lindsay as a cyclical play, since their fortunes are just so deeply tied to farm incomes and macroeconomic road spending. Lynch also loved using the PEG ratio, that's price to earnings relative to growth. But here's the catch. Lindsay currently has a negative PEG ratio of negative 0.4. Why? Because their recent EPS actually shrank by over 54%. Furthermore, Lynch always evaluated who is actually buying the stock. While institutional ownership remains really high, assuming minimal insider buying recently based on the lack of major insider accumulation reports during this dip, there just isn't a strong signal from the people running the business. Combining all that with shrinking earnings in a cyclical downswing would likely trigger a hold for him. He'd advise waiting to buy until the agricultural cycle bottoms out and earnings actually begin to turn upward. Section 4. DCF and Alternative Valuations. Now let's bridge these classic frameworks with some modern quantitative modeling. To build our discounted cash flow, or DCF model, we basically follow 3 steps. Step 1, we forecast the company's future free cash flows, making sure to account for the delivery of that massive $80 million MENA project. Step 2, we project a terminal value, assuming a very conservative 2% perpetual growth rate, which keeps it in line with historical inflation. And finally, step 3, we discount all those future cash flows back to today's present value using an assumed 9% weighted average cost of capital, or WACC. This appropriately reflects our current interest rate environment and market risk. Of course, running a sensitivity analysis is absolutely crucial here. A DCF is really only as good as its underlying assumptions, right? So if we flex the WACC between 8 and 10% and the growth rate between 1.5 and 2.5%, our base case midpoint lands at a fair value of $112. Depending on how optimistic or pessimistic you are, the fair value per share ranges between $95 and $130. Currently trading at $124.85, the stock is sitting right up near the upper, more optimistic bounds of this DCF model. To make sure we aren't relying entirely on just one model, let's apply some alternative models as well. When we look at comparable company multiples against peers like Alamo Group and Titan International, adjusting for Lindsay's margins, of course, we get an implied fair value of about $118. Furthermore, if we run a dividend discount model based on their very steady $1.48 annual payout, it yields a fair value of roughly $115. Notice how all these quantitative models are starting to cluster tightly together? Section 5, Synthesis and Final Verdict. Bringing it all together in this master synthesis table reveals exactly where we stand. The Graham intrinsic value is highly conservative, down at $77.33. Our DCF midpoint sits at $112. The comparables model points to $118, and the DDM suggests $115. Yet the current market price is $124.85. This tells us unequivocally that the stock currently trades at a premium to almost every single calculated valuation approach we've run today. So what is our final recommendation? Well, it has to be a hold. Listen, Lindsay Corporation is undeniably a high-quality company. They boast a pristine balance sheet with more cash than debt, and management is aggressively buying back $150 million in stock. That is incredibly reassuring for long-term investors. However, blending all our insights, the cyclical headwinds spotted by Lynch, the lack of consistency noted by Buffett, and the strict margin of safety demanded by Graham in our own DCF, results in a firm hold. We really should wait for those agricultural headwinds to fully subside and hopefully push the price down closer to the $110 to $115 range to present a true, reliable margin of safety. You know, analyzing a company through multiple lenses gives us a true 3D picture of its value, and it completely protects us from our own blind spots. So I want to leave you with this final thought to ponder today. When you are looking at a highly cyclical stock like Lindsay Corporation, which of these legendary investment frameworks do you actually trust the most to navigate your own portfolio? Thank you so much for joining me on this explainer. Keep learning, keep analyzing, and stay focused.